Good evening, everyone. Let's just go through this example from the New Era Grade 10 textbook. I think I did this example and I did the next one, and then I gave you guys activities on this just to explain depreciation. Remember, depreciation is the cost of using an asset. And we recognize this cost from when the asset is available for use until it is either sold or we just got rid of it. Here it says that Arthur RT Trading is an RT's, as RT supplier started his business on the 1st of March 20.7. On this date, he bought a vehicle for 150,000 and equipment for 80,000. He paid by EFT for both items. At the end of the financial period, that is the 28th of February 20.8, depreciation on both fixed or tangible assets must be brought into account as follows. They gave you vehicles at 20% according to fixed installment method, equipment at 15% according to the diminishing balance method. I kind of like this textbook, especially when it comes to this topic. As a matter of fact, for grade 10 syllabus, I think it's a very, very good textbook, even though they made a couple of mistakes when it comes to the numbering. I mean, task 10 point something won't be the same as task 10 point something in the other textbook. But beside that, it is a very, very good textbook. All right, let's just check how we're gonna do this and how we're gonna record it. I will first calculate depreciation for both methods in this case, because these assets were bought, this vehicle and equipment were simply bought on the 1st of March, which is the beginning of the financial year. All right, 1st of March 20.7. They are both new, therefore they will not have accumulated depreciation. Now, it's pretty much the same as though we're calculating depreciation on cost method for both. Now, we'll start with vehicles. Vehicles, I will simply take the cost price of vehicles, which is 150,000, multiply it by 20% and multiply it by 12 over 12. Know that I'm multiplying by 12 over 12 because for the 2018 financial year, for the financial year that starts on the 1st of March 20.7 to the 28th of February 20.8, we used this vehicle for the entire financial year. That is why I'm multiplying it by 12 over 12. If I only use it for 6 months, I was going to multiply this whole thing by 6 over 12. So it's very important that you draw the current financial year so that you don't make mistakes, and make sure that you do not miscalculate your months, especially the month you bought the asset. Now I'm going to start with my financial year. My financial year will start on the 1st of March. So I will have here 1 March. It's 20.7. And here I will have 28th of Feb. That will be 20.8. So these assets were bought here. They were both bought on the 1st of March. So we've used them for the entire year. That is why here I'm simply multiplying by 12 over 12. Okay, that is depreciation on vehicles, and depreciation on vehicles here will simply be 30,000. Note that we are calculating depreciation on diminishing. Well, on vehicles, it's on fixed installment method. Okay. However, on equipment, it will be on diminishing balance method. And when you calculate depreciation on diminishing balance method, you first have to find the carrying value. However, in this specific example, the carrying value will be the same as the cost price. That is because this equipment will not have accumulated depreciation. It is new. It doesn't have accumulated depreciation. So when we calculate depreciation on equipment, it'll just be 80,000 times 15% times 12 over 12, and the depreciation on equipment here will be 12,000. So the total depreciation for the current year will be 12,000 plus 32,000. That is both the depreciation on vehicles and depreciation on equipment. So when you add these two, when you add 30,000 and 12,000, you will get the total depreciation of 42,000. Depreciation, please note that it is an expense, and expenses are debited. That is why in my general journal, depreciation will be calculated in the general journal. It is what we refer to as an imputed expense. It is not a cash expense. No money was paid for depreciation. It's a non-cash item. And since it's a non-cash item and we can't say that we bought it on credit, it's an imputed expense. That's why we're going to record it in the general journal. So when we record it in the general journal, we will simply debit depreciation by the total depreciation amount of 42,000. That is because depreciation is an expense and expenses increase on the debit side. And I've included a note for that. And then we're going to split this depreciation. This depreciation is divided between depreciation on vehicles and depreciation on accumulated depreciation. Accumulated depreciation is intended to reduce the value of your asset. That is why accumulated depreciation goes up on the credit side. So we are going to start with accumulated depreciation on vehicles, meaning that for the current year, our accumulated depreciation on vehicles will increase by the depreciation on vehicles for the current year, which is 30,000. It will increase on the credit side. That is because it's a valuation allowance that helps us value assets at the correct value. That is why it increases on the credit side whenever depreciation is recognized. And then we're going to have accumulated depreciation on equipment. This is the depreciation on equipment, and it will be 12,000. And when you add the credit side, it will give you a total depreciation of 42,000. For your narration, you just specify that this is depreciation on vehicles at 20%. On cost, and on equipment, it will be 15% per annum on diminishing balance method. And that's how you will recognize depreciation. I hope it makes sense. Please note that accumulated depreciation, as per the definitions I gave you in class, it's simply the sum of all depreciations from when the asset was purchased up to the day we're going to sell this asset. In this case, we will keep on adding our depreciation into the accumulated depreciation account for as long as we've got this asset. We will only reduce that account by the accumulated depreciation of the asset that we will be selling as at the date of the sale of that asset. We will deal with that later on. How do we record this whole transaction in the general ledger? Please note that we are going to debit vehicles. Our vehicles will simply increase on the debit side because it is an asset account. So we'll start with the 1st of March. We bought this vehicle on the 1st of March. It will be recorded in the CPJ. That is because we bought it for cash. Remember, they said we paid for this vehicle via an EFT. All right. And then for equipment, we're going to have the same thing. Equipment will increase on the debit side. We will have bank because that was also paid for in cash, and it will be in the CPJ. The amount for equipment, the cost price for equipment was 80,000. Accumulated depreciation on vehicles, as I have specified, this is used to devalue your asset. Therefore, it will be minus plus. This account will be minus plus, meaning that it will increase on the credit side. So it will increase on the credit side by the current year depreciation. It will increase on the credit side by the current year depreciation. That is why under accumulated depreciation on vehicles, we will simply have depreciation on those vehicles for the current year, and that will simply give us the total depreciation of 30,000. And accumulated depreciation on equipment will increase again on the credit side by the depreciation on equipment for their current year, and the accumulated depreciation on equipment will simply be 12,000 rand. The last part will simply be your depreciation account. Please note that depreciation account is an expense account, and we did this last year thoroughly. Expenses will increase on the debit side and they decrease on the credit side. So it's a plus minus. So this account will increase by current year depreciation. It will increase by current year depreciation. Therefore, when it increases by current year depreciation will be divided between depreciation on equipment and depreciation on vehicles. That's why we're going to have accumulated depreciation. It will be recorded in the general journal, not CPJ. It will be recorded in the general journal, and the amount will be 30,000. Accumulated depreciation on equipment will be in the general journal as well, and the amount will be 12,000. Okay, and the explanation is simply that depreciation is an expense and is debited. Like all other expenses, depreciation decreases owner's equity. That is, owner's equity will be minus. All right. And separate accounts show the accumulated depreciation on each asset. The accumulated depreciation account may be regarded as a valuation account that decreases the value of your asset. That's why accumulated depreciation account increases on the credit side. I'm going to continue with the same example and show you what will happen when we have accumulated depreciation on those two assets. Okay, now here it's simply the second year, which is um, 2018. Now, meaning that our financial year here in this example is 2019. It runs from the 1st of March 2018, I mean, to the 28th or 29th of March 2019. Okay, how are we going to calculate depreciation on vehicles here? To calculate depreciation on vehicles, the first thing that you need to do is to draw what we refer to as the number line, which shows what the beginning of the financial year is and what the end of the financial year is. So the year will start on the 1st of March 2018. It will end on the 28th of February 20.9. So because they said vehicles are depreciated at cost price, you need to always get into the habit of calculating carrying value of the asset that you're depreciating at the beginning of the year. Remember, I said carrying value is the cost price minus accumulated depreciation of that asset at the beginning of the financial year. The cost price of vehicles at the beginning of the financial year is 150,000. Accumulated depreciation on vehicles at the beginning of the year will be 50,000, meaning that the carrying value at the beginning of the year will be 120,000. Note that for the 2019 financial year, we have used this vehicle we have used the vehicle the entire year. When you calculate depreciation, we will simply take 150 because 150 is the cost price of this vehicle. Because when you calculate depreciation on cost price, you will simply use the cost price of that specific asset. So you're going to take the cost price of vehicles and multiply it by your depreciation rate and multiply it by the month that you have used over the total number of months, which is always 12. In this case, this vehicle was used for 12 months. That is why we're multiplying it by 12 over 12, which is basically 1. So if you use your asset for the entire year, there is no need for you to multiply by 12 over 12 because by multiplying by 12 over 12, it is the same as doing multiplying by 1. The numerator and the denominator are the same, so that is just equals to 1. Depreciation on vehicles for the 2019 financial year will be 30,000. The reason why I asked you to calculate carrying value at the beginning of the year is to make sure that current year's depreciation never exceeds the carrying value at the beginning of the year. Okay, make sure that the current year depreciation never exceeds the carrying value at the beginning of the year. You will learn this later on. If your current year depreciation exceeds the carrying value at the beginning of the year, you will limit your current year depreciation to the carrying value at the beginning of the year minus 1. Please rewind and replay what I've said and write it down and keep it in your memory because you will need that in the future. All right, on equipment, we are depreciating equipment on diminishing balance method. I will start by calculating, by checking out what my financial period is, which starts on the 1st of March 20.8, it ends on the 28th of Feb 20.9. Therefore, when I calculate depreciation again, I do the same thing that I did under cost method. I'm simply going to calculate the carrying value at the beginning of the year by taking the cost price of the asset. In this case, the cost price of equipment is 80,000. And then I minus accumulated depreciation on equipment at the beginning of the year. Please note that accumulated depreciation on equipment at the beginning of the year, they told you that these are the balances at the beginning of the year. All right, these are the balances at the beginning of the year, and they told you that it's on the 1st of March. That's what I am simply emphasizing these are the balances at the beginning of the year. I just want to make it a little bit visible. These are the balances at the beginning of the year. So that accumulated depreciation amount on equipment and that accumulated depreciation on vehicles, both of them are at the beginning of the financial year. All right, meaning that the carrying value on equipment at the beginning of the year will simply be 68,000. So we agree that we have used this equipment for 12 months, but we are depreciating this equipment at diminishing balance method. Okay, we are actually depreciating it using the diminishing balance method, not the cost price. Therefore, when I calculate depreciation using the diminishing balance method, I am simply going to take the carrying value at the beginning of the year. The carrying value at the beginning of the year is 68,000. I will simply take that and multiply it by 15 and multiply it by 12 over 12, and that will give me 10,200. Again, you need to make sure that current year depreciation doesn't exceed accumulated depreciation at the beginning of the financial year. Okay, we did see that accumulated depreciation on vehicles for the current year is 30,000. Depreciation on equipment for the current year is 10,200. My question to you is, what is the total depreciation for the current year? The total accumulated, the total depreciation will be that 30,000 plus 10,200, which will give you 40,200. So depreciation for the current year, which is depreciation on both equipment and vehicles, will simply be 40,200. Depreciation increases on the debit side, as I've said. And then we're going to split it between accumulated depreciation on vehicles. So our accumulated depreciation on vehicles will be going up from 30,000 to 60,000 because we're recognizing an extra 30,000. And accumulated depreciation on equipment will also increase from 12,000 at the beginning of the year to 10,000. By 10,200, which will give us 22,200. Okay. Now let's check how true that is by preparing the general ledger account. Because the vehicle was bought last year, so for this year, we're gonna have it as balance brought down. It was bought last year, so it will just be balance brought down. For equipment as well, it will be balance brought down because it was bought last year. Accumulated depreciation will have balance brought down on the credit side, but this is only accumulated depreciation on vehicles. Accumulated depreciation on vehicles. Accumulated depreciation on vehicles balance at the beginning of the year was given to you as 30,000. We recognize depreciation on vehicles in the current year, which was 30,000, and that will be written at the end of the financial year. And we're going to write it as depreciation contra account. It was recorded in the general journal. It will be 30,000. Our accumulated depreciation at the moment will now be sitting at 60,000. To balance this off, we are going to have balance carried down on the debit side of 60,000, and we're going to bring it or take it forward to the following month of following financial year, which starts on the 1st of March 20.9, and the balance brought down will simply be that 60,000. And then we're going to have accumulated depreciation on equipment. Accumulated depreciation on equipment balance. Remember, accumulated depreciation will increase on the credit side, it decreases on the debit side, it's minus plus. Accumulated depreciation at the beginning of the year was simply 12,000 rand. It increased by depreciation for the current year, and depreciation for the current year was 10,200, which takes it to 22,200. Now that will be the carrying value to balance it off to make sure that we have same amounts on both sides, and we're going to take it forward to the following month. Please note that this shouldn't be balance brought down. Instead, it should be balance carry down. Okay. And then we're going to go to the depreciation account. Depreciation account, I said it's an expense account, it's a plus minus. So it'll increase by only current year depreciation. So it will be increased by current year depreciation on vehicles, which was 30,000. And it will also increase by current year's depreciation on equipment, which is simply 30,000. How do we recognize this though in the accounting equation? The accounting equation, accumulated depreciation will decrease your assets. That's why I've got minus 30,000 for accumulated depreciation on vehicles, minus 30,000 under owner's equity. That is because depreciation is an expense and it reduces owner's equity. And then I'm going to have minus 10,200. That is not accumulated depreciation on vehicles, it's accumulated depreciation on equipment. Okay, it's on equipment. This one is on equipment. Not on vehicles, it's on equipment. This one is on equipment. Okay? Accumulated depreciation on equipment. Okay. And that will be 10,200. And depreciation will reduce the owner's equity by 10,200. Now go to your textbooks and attempt this classwork here, which is classwork 1 is task 10.8. Task 10.8. The task number might be different from what you have in the textbook. Just confirm with the values to ensure that you are and doing the right classwork. It's new era grade 10, task 10.8. Okay, check out the next videos as we will be going through that.